We hope everyone is as excited as we are to be here for the real estate investing in the post-pandemic market. We're going to be starting here in just a couple of minutes. We're just bringing in all of our panelists and co-hosts back with me today. So huge shout out to our attendees. Quick running down the list. Guys, if you're here and if you're in chat, go ahead and drop a hello. Where are you coming in from? We got David Luna. We got D. Hughes, Donna Holmquist, Jake Gregg, Jeff Welgan, Justin Kernan, Kathy, Mark Gelbman, Martin, Marty, and Sandra Patrick Hostetter, Ranjit Mukherjee. Sorry, I probably slaughtered your name there. Stephen Ringgold, Steve Miller, Terry Kurz, Thomas, Tiffany, Tracy. Welcome, welcome, welcome. Excited to have you guys all here. And just giving everybody a heads up, we are doing a question and answer at the end of this. If you guys, like I said, we have some of the absolute most brilliant people in all of real estate investing joining us today. You are going to want to be able to take advantage of their knowledge. What better opportunity do you have? Have you been thinking about it? Are you just wondering about the real estate investing market? Today, you're going to get all your questions and so many more answered. We're going to be getting into it here in about 1 minute. If you didn't have somebody in your office register right now, send them the link. Say, hey, you need to get on this. You want to be part of this. Share it throughout your office. Share it on your social feed. Say, hey, we got the best of the best in real estate investing. You're not going to want to miss this. So do it right now. What are you waiting for? Just hit the share button. That's all you got to do. Make it happen. Let's fill the chat. But drop it in right now if you're just joining us. Appreciate you guys being here. And we're, like I said, we're going to start introductions here in just a second and get into the meat and the potatoes of it. Some of these people are old friends of mine. Some of these people are new friends of mine. But I can tell you what, we're going to be bringing you the fire today. We're going to be bringing you so many good tips, strategies, and the things that you need to know about real estate investing in this post-pandemic market. Glad that all of you could make it this afternoon. It is afternoon. I said morning earlier, but it's officially afternoon. Let's do this. Depending on where you are, 3 p.m. Eastern time, 2 p.m. Central, 1 p.m. Mountain, and noon on the West Coast. Let's do it. Ladies and gentlemen, welcome officially to the real estate investing in the post-pandemic market. My name is Josh Pitts. I am the host and CEO of Shred Media and the Shred Show. I'm excited to be welcoming all of you to this event, this webinar. And like I said, there's some new faces on here. There's some old faces on here. And we don't just mean old by Rick Sharga. We mean the best of the best when it comes to this. But we have the lovely, the incredibly talented Liz Faircloth joining us, real estate and investor. She is actually, not only is she the co-founder of the Real Estate Investor Community, a platform that empowers women in real estate investing to live financially free, but she is also the co-founder of the DeRosa Group. Hopefully I said that right, Liz. With her husband, Matt. Not this Matt, whole nother, no confusion here, ladies and gentlemen. We don't want any confusion going on. But she is also the owner of a commercial and residential property with their mission to transform lives through real estate. Oh my gosh, that gives me goosebumps saying that. And that's exactly what she is doing. We're so excited to have Liz Faircloth with us. Liz, welcome. Excited to have you here today.
Thanks for having me. Thank you for the intro.
Of course. And then of course, moving next to Matt Argersinger. Dang it, Matt. I was so close. I was getting ready. I was like, yes, I'm going to nail his name. And then of course I saw Matt. So excited, guys. If you don't know Matt, you must be not following Million Acres. You must not follow Motley Fool, and you're fools for not doing it. You got to go follow him right now. Matt is the lead investor of the CRE over $1 Million Acres, the information platform for real estate investors. Really, we're going to be getting in, and Matt's going to be sharing some information that is just going to blow your minds here today, ladies and gentlemen. They have the best and longest track record. Matt has a portfolio manager who will be managing the Odyssey One portfolio in Supernova for 7 years. Most I don't even know what the heck it is, but it sounds really amazing. It's super exciting. He's going to tell us more about it. Welcome, Matt, to the show. Matt, excited to have you here.
Oh, thanks, Josh. Excited to be here.
And of course, last, but certainly not least, you've seen him on the show before. You know him. You love him. The executive vice president of RealtyTrack, the leading foreclosure search and discovery website in all the mortgage industry. He's been featured, that's a mouthful, on CNN, ABC, Fox, Bloomberg, NPR, so many more. Ladies and gentlemen, Rick Sharga of RealtyTrack. What's up, Rick? Good to have you back.
Always a pleasure, Josh.
You say that with just such a smirk on your face. I bring the energy and you just bring the info. That's where you and I just play out each other so well. I'm excited to dive into this. Like I said, we want to thank everybody who is here today. We have a lot of people joining us. And like I said, there is so much great information that we're going to be getting into. You're not going to want to miss this. Please stop yelling. Kelly, I'm just excited to be here. I'm super pumped. If you've ever been part of my show, you just know we bring energy. When it comes to mortgage, real estate, and investing, and especially real estate investing, sometimes we just got to put a little bit of enthusiasm behind it. But we're going to be getting into this. And I want for those of you who don't know, I know I did an introduction, but I want to do this real quick. I like to get personal. Everybody likes to know that about me. I like to get personal. I like to get deep. I like people to share. So I want to take just 30 seconds from each of you, starting, of course, with Liz, and tell us just a little bit about yourself, a little bit about your background in real estate investing.
Sure. Yeah, it's excited to be here. Thanks so much, Josh. So just in a nutshell, I was getting my degree in social work. I wanted to be a therapist. I wanted to help people in that way, as was my passion. And at the same time, my brother-in-law handed me Rich Dad, Poor Dad, which I think a lot of investors read at some point, right? And terms I never heard of, right? Passive income and all the great nuggets in that book and what have you, really opened my eyes to a whole new world of maybe building a business and buying investments and having those investments work for me, and just things I never really grew up thinking about. Grew up in a great hardworking family, but just things I never thought about as a 20-year-old at the time. So my husband read the book. I gave it to him. He was an engineer, and we're like, I think we want more in our for our lives and everything. And we love it. We love what we do, but we would love to create wealth, long-term wealth for our family, and that we didn't have. And so we weren't married, and took courses at a local RIA meeting, one of those, it's called DIG, one of those local RIA meetings that you go to, and Carlton Sheets and a bunch of old school, guys were doing like the pitches in the front of the room, which I don't know if anyone knows Carlton Sheets now, but anyway, we bought a course and started our path that way about 16 years ago, not knowing much. We didn't have the money to put down on our first deal. We borrowed it from my father. So that was our first private money deal. And we bought a duplex, and that kind of started our career our path of investing. My husband quit his job. I kept working so we can kind of, have a dual approach to this, business of investing. And now we have about over 1,000 units in 4 states, and we focus mostly on large multifamily. We dabbled in a lot of different things. I've done flips over the years, new construction, commercial, raw land, and we were involved with a lot of different things, but kind of went all in on multifamily and scaled a multifamily portfolio. I love real estate, but I'm also the co-founder of the Invest Her community. So we actually create content and empowering community for women in this business of investing, because at times, in terms of construction and all the fun things you get involved in this business, sometimes you feel like you're the only woman in the room. So we really wanted to create a community, me and my partner, Andressa, where we can really support women through a community. And we have a podcast and meetups, 51 meetups around the country and Canada, where women can kind of come together and support each other. So anyway, that's the long short of it. I'm still an active investor, but my heart and passion is really building our community of women so we can support more of them.
That is absolutely amazing. And I love your story because, again, you started with one property. It all starts with one. Everybody's got to start somewhere. It starts with that base, and then you build from there. So incredible story. You're doing such phenomenal work with the Invest Her community. So huge shout out to you, Liz. Thank you for being with us. Matt, again, I hopefully I did an okay job with your introduction, but for those who don't know you, a little bit about yourself, how you got started in all this.
Yeah, you bet. Like Liz, my wife and I, about 10 or 11 years ago, bought our first rental property, also a duplex, and that was kind of our entrance into the market. At the same time, I was a young analyst at the Motley Fool and buying rental properties on the side. And then a few years ago, a couple of us at the Motley Fool got together and said, could we do for stocks, could we do for real estate what the Motley Fool has done for stocks for decades? And we thought, yeah, we could do real estate. Let's do something. So we launched millionacres.com. Which is a site that really goes everywhere in terms of real estate, from renovating your kitchen to buying private commercial real estate.
We might have lost Matt there. He even mentioned he had a little bit of connectivity issues. So we're going to let his connection come back here. And as we're doing that, we're waiting for him. We're going to go over to our good friend, Rick Sharga. Like I said, He needs no introduction. He's been on the show many times, but he is truly one of the most brilliant when it comes to real estate data. Rick, for those who don't know you, a little bit of background on yourself.
Yeah, I'm probably the odd duck in this pod. Wait, I think Matt's moving again. Are you back, Matt? Nope, he was moving. I'm the only non-active investor in the session today. I've been working with investors for the better part of the last 20 years while I've been investing in companies. So I was at Realty Track for about a decade. I spent some time with a group called Carrington Mortgage Holdings that owns and operates a bunch of companies in the mortgage and real estate business, and also spent some time building auction.com and 10X, where we worked pretty much exclusively with investors who were looking to buy distressed assets, both in the residential and the commercial space. And I've come full circle. I'm back at Realty Track again now for the last year. We've launched a new version of the website that's targeted to individual investors. Although we do also work with a lot of real estate agents who either invest themselves or work with investors. So I've been in and around the investment community now, again, as I said, for probably the last 20 years. Have a special soft spot in my heart for people that are risk takers like Liz and Matt, who venture into the world and do this. And we try and present whatever data, whatever tools, whatever resources we can to make their lives a little easier and their investment careers a little more successful.
Data is at the forefront of everything these days, Rick, and I know we're going to be getting into the data conversation here shortly. But before we do that, Matt is back officially. And I got to say too, I love Matt's headset. Coming from a gaming background, from like a sports background, he's like the telecaster. He's like, yeah, he's getting into it. So I love it. Huge shout out to Matt on the headset. But Matt, you tell us a little bit about your story, starting a million acres before your connectivity cut out there. So a little bit more as you finish up with your A Million Acres introduction.
Yeah, sorry about that. I got all the technology, but not the good internet connection, which is just sad. But yeah, we started millionacres.com a few years ago. And in addition to Million Acres, so that's free content covering really the spectrum of real estate, from flipping houses to investing in private real estate. We also launched a couple of premium services behind the paywall. One of them that I work on invests in private deals, ranging from multifamily that Liz is invested in to office developments, hospitality, really all the categories of private commercial real estate. And it really is the technology of the last 10 years when you think about crowdfunding and the access that retail investors have to private deals nowadays is really the reason we launched Million Acres, because now there's just so many different ways, different vehicles that investors can use to access the private markets. And so we think it's really exciting, and we're excited to every day be introducing individual investors to the asset class of real estate, because I think for a long time it's felt out of reach from a lot of investors, especially on the retail side. So it's nice that we can sort of provide a window to opportunities in the commercial world.
Say providing opportunities to anybody and everybody. Cool story that you guys both started with, Liz and Matt started with duplexes. And I'm pretty sure it's like part of the curriculum to get into any type of real estate investing or entrepreneur. You have to read Rich Dad Poor Dad, Liz. I think that's just kind of the beginning of it all for all of us. And by the way, ladies and gentlemen, if you are checking out our chat, our incredible team behind the scenes has posted the links for every single one of these participants today. So you can go check out Liz, Matt, and Rick on all their social links in the chat. So make sure you click on those and go follow these guys. Like I said, you don't want to miss a single post or single update from them. But let's jump into this. Let's jump into the mean why we're all here today, because COVID continues to be a major disruptor in the world economy, continues to be a major disruptor in America's housing inventory in our market. And that's exactly what we want to discuss today, because as our government, as things are being put in place to take away the mortgage and rental safety nets, the question is an explosion of foreclosures, are they just around the corner? A flood of vacancies, a flood of open properties, is that just around the corner? So today I'm excited to kind of start our discussion with you, Rick, and talk about something that I think all of us are wondering. Is a foreclosure tsunami coming? Is it just around the corner? Is it something we should be prepared for?
Yeah, it's a fair question, Josh. It's something that a lot of investors are keenly interested in because, let's face it, foreclosures typically represent some of the best values on the market. They tend to be very popular properties for investors to look at. Particularly investors who have their infrastructure in place where they can take on a property that probably needs some work, rehabilitate it, and get it ready either to be flipped or to be to be rented out to a family. And by the way, I think that's one of the things that investors contribute to the housing market that often is overlooked. Investors don't, contrary to popular belief, gobble up all the available inventory and make it unavailable for first-time home buyers. There's a very popular meme running through the mainstream media, which is that Wall Street is gobbling up Main Street, and it's simply not the case. The data doesn't support that. In fact, investors, particularly individual investors, wind up adding inventory into the market by taking properties that are distressed, that are not in a condition to be purchased by home buyers, and bring them back to the market. Specifically to your foreclosure question, when the pandemic hit, we were actually looking at about half as many foreclosures as we normally see historically. Historically, about 1% of loans go into foreclosure in a given year. And it's because a homeowner gets into some sort of financial distress. There's a divorce, there's a medical condition, there's a job loss, there's something that makes it impossible for that person to continue paying for their mortgage. Prior to the pandemic, we were looking at about 0.5%. So the loan quality was extraordinary. The number of homes in various stages of foreclosure was very low. And then the pandemic hit, and we had a severe recession. We saw unemployment go up to 15% virtually overnight, 5 times about what it had been prior to the pandemic. We saw 22 million jobs lost. And the speculation was that when the dust settled, we would see millions and millions of borrowers go into foreclosure. The reality is very, very different. There has been unprecedented work done by the federal government, by state governments, even local governments, working in tandem with the mortgage industry. And candidly, in the 20 years I've been in the business, this is probably the most successful example of the government and the industry working together for a common goal. We've prevented millions and millions of unnecessary foreclosures from happening. And when I say unnecessary foreclosures, I mean a foreclosure that wouldn't have happened except that a borrower was impacted negatively by COVID-19. So the forbearance program the government put in place as part of its activity made it possible for people to skip mortgage payments if their income was affected by the coronavirus. It was originally a 6-month program with an additional 6-month option. The government has since extended it to 18 months. So this month and next month, we actually have the first large wave of borrowers who entered the forbearance program when it started, getting ready to reach the expiration of their terms. So we have about 1.5, 1.6 million borrowers still in the program, and about half of them are going to exit between now and the end of the year. And you'd think maybe that these 1.6 million people would all become very vulnerable to foreclosures, unless you really look at the numbers. And this is why I know you love data, Josh.
I was going to say, I know you have data here for us, Rick, so I'm excited to hear it.
We've actually had more than 8 million We've actually had more than 8 million people go through this forbearance program. That means 6.5 million of those people have already exited, and they've done so successfully. In fact, according to the Mortgage Bankers Association, about 85% of these people have left either continuing to pay their mortgage, about a quarter of them never stopped making payments, or with a repayment plan in place, or they paid off the loan. Only about 15% have left without a plan in place, and most of those either wind up working something out with their lender or re-entering the program. So virtually nobody has gone from that program into foreclosure. And the proof of that is we've had 9 consecutive months where there have been fewer mortgage delinquencies than the prior month. And in fact, if you look at new delinquencies, 30-day delinquencies, they're the lowest numbers that the MBA has ever recorded since they started tracking this in 1979, before you were even born, Josh. So the fact of the matter is we're seeing most of these people exit very successfully. Most of them will not go into foreclosure. 98% of the people in the program have more than 10% equity. So even if they can't resume making payments on their loan, they'll have the option to be able to sell off the property rather than to lose it at an auction. Now, full disclosure here, I would be completely insane to tell you that we lost 22 million jobs and we're not going to see an increased level of foreclosure activity. So we will see some, but I think we're going to wind up going back to something closer to normal, maybe 1%, maybe a little bit more than 1%. That means that in the course of a year, there'll be about 500,000 properties in some stage of foreclosure. But if you're an investor looking to participate in the foreclosure market this time, you have to think completely the opposite of the way that the Great Recession worked. During the Great Recession, 6 million people lost a home to foreclosure. Almost all of those homes went back to the lender. They weren't sold to investors initially. The lenders repossessed them. And that's where you had to go look for your inventory. If you do that this time, you're going to miss the entire wave. This time, 75% of homeowners have more than 20% equity. I just mentioned 98% of the people in forbearance have 10%. We have a huge supply and demand imbalance in the housing market, much more demand than there are homes available for sale. So most of these borrowers, even if they find themselves in distress, are going to be able to sell the properties before the foreclosure auction takes place. So as an investor, if you're looking for those opportunities, it means you need to identify those properties early in the foreclosure cycle and work directly with that homeowner to negotiate a deal that lets them walk away with money in their pocket, with all their mortgage debt paid off, and lets you get a property at a good rate. And that's the big difference in this cycle's foreclosures compared to last cycle's. And now I'll shut up and give some airtime to somebody else.
No, this is exactly what I want, because this starts to kind of lead in, because now we get to talk with Matt. Now we get the facts. Again, Rick, you always have the data, the facts, they kind of back up everything, which I think there is some fun. There's a little bit of fun when it comes to the real estate investment with the foreclosure. And sometimes that's just the way the media spins things, especially in real estate right now. There's always that little bit of fear. So, but now it is different. I think I 100% agree with you. For all those who are looking to get into real estate investing, to really like, okay, there's a wave of opportunity coming. That's where we bring Matt and Liz and we start actually talking about it. And again, these are people who have done it. They're in the thick of it right now. So Matt, I want to kind of turn it over to you for a second and let's start to unpackage this a little bit. Because now Rick has given, like I said, he's given us the numbers, he's given us the facts. Not as many homes. There's going to be some. We all understand that. Absolutely. In any type of economic distress that we've seen, we're going to see a little bit. You're going to see some fallout. But for the majority of them, most of them have found a solution to, either keep up with their payments. But how, with Million Acres in particular, your recent CRE deals, talk about some of those that you've recently had and how people are actually finding more deals, especially with this opportunity right around the corner.
Yeah, I mean, it's interesting. My vantage point is mostly on the commercial side, and what we saw on the commercial side was we never really saw the acute distress. You saw distress in certain areas like hospitality, retail, which is already experiencing pain, the office side, which remains uncertain, but and say, I'm getting this asset at a bargain. What we saw, and I think Liz is going to have a lot to say about this, but we kind of pivoted during the kind of onset of COVID and said, what area is going to hold up the best and probably produce the best returns, risk adjusted, and we found multifamily to be that spot, and particularly looking at multifamily, Class B multifamily in certain hot markets. Like if you think about places like Austin, Texas, or Tampa, Florida, or other places like that, where all of a sudden you probably had people moving there because of the pandemic, but you also had maybe this foreclosure crisis, people are going to be leaving their homes. This was the natural place for them to land. And you talk about supply-demand imbalance. I know Rick just talked about supply-demand imbalance within the housing market. In the rental market, you also have that as well, because you have a really lack of affordable housing in a lot of markets. A lot of the new development over the past, going into COVID and really now as well, it's all luxury Class A development. And so you have a real need for Class B multifamily. I think there's tons of opportunity for investors looking to put money to work in those kinds of situations where you can go in, rents are probably $100 or $200 a month less than the prevailing market rate. You can go in and do some improvements to that property and find ways to invest. And what we've done at Million Acres is we've partnered with sponsors and firms who have gone in and bought these properties with the intention of renovating them. You can invest right alongside those sponsors and earn a nice return if they can make those renovations happen, sell the properties in a few years at better rents. And I think those opportunities still exist today in abundance.
Well, and that's exactly what the program, and because many people are probably on here wondering like, well, how can I, commercial real estate, like that's a whole ball. Like, how do I even get started in there? That seems like such an overwhelming process, but that's exactly what Million Acres and the program that you guys have set in place. That's kind of what it's there is there to help and to leverage your guys' platform so they can invest in these properties in inventory, correct?
That's right. That's right. I mean, we're scouring the market. We're looking at probably dozens of deals every month, and very few get through our filters. But we're focusing on those areas, on those markets that we think have good demographic trends in demand, and where we think there's opportunity. One concern that investors have, that I have, and I'd love to have Liz comment on this because she's going to know more than I do, is just some of the valuations are getting pretty steep in a lot of areas, particularly in multifamily. You're seeing cap rates fall in the 4.5%, low 4% range, which historically is really unprecedented. Part of that is because interest rates are, of course, historical lows, but there's definitely a healthy spread, usually a healthy spread between interest rates and cap rates, and we've seen just so much compression across the board. And so, there are opportunities. You just got to pick your spots, but I do worry about some of the valuations you're starting to see in some markets.
I was going to say, Liz, go. I'd love your kind of, I guess, your comments on that, because we are starting to see that. I saw Rick's head start to shake. I know we've all started to hear that. Some of the valuations, getting a little bit on high side. So what are your thoughts and take on that? Liz, you're muted. Hold on. You're going to say something brilliant and I don't want anybody to miss it.
I know. I'll be like, didn't you all hear me? And I'm muted. No, yeah. I mean, what we're seeing, I'll just give you some statistics of what we've experiencing on the end of purchasing, right? Going out there and, yeah, people are overpaying, hands down, in a very tactical perspective, from a small multi to large multi. We're making more offers on 50 units plus. So between 50 and I'd say 400 units is it's a big range. But just to give you a reference point, we've underwritten 200 deals this year, the most we've ever underwritten. And we have a team of people helping us, right? It's not me. I mean, I'm not the best underwriter. That's not my strength. And you need people who are focused on that. And we've made offers on, and then just the funnel goes down and down. So we're getting outbid numerous times, and we're not a new player to the game. We have a reputation. We've closed a lot of deals. We've been in this business for a long time. So I say that because we have closed a few deals, and the way we've been able to do it from the perspective of making sure you're not overpaying, you have to stay close. You have to stay very firm to your numbers. And that's on any kind of market, especially right now. We're selling a 200 unit in Fayetteville, which is in North Carolina, not on the hottest market list, but it's very, more and more become more popular, and we're doubling, we've doubled our returns for our investors, which is great. But we had 30 offers in Fayetteville, North Carolina, right? This is not Raleigh, North Carolina. Wow. And I'm not saying anything's wrong with Fayetteville, but I'm giving you a reference point and these were strong companies, right? These weren't just like, I woke up and I want to invest in real estate and I sold my company and I have some money to put to work. These were a number of them were strong operators. So I say that because it could get a little overwhelming, especially for people trying to break into multifamily right now. We're getting outbid and we're still able to make some things work, and we're pretty seasoned, so to speak. So what do people do when they're starting out? That's the question mark, right? And that's the challenge. I don't know if you want to answer that, because I know that's on my list.
Let's unpack. I was going to say, we're going to go totally off our outline here.
Okay, I don't want to get off topic. I know.
No, this is how our show rolls. Anybody has ever watched this?
That's how I am on my podcast.
So how do you? Because let's just say I'm a brand new real estate investor. I just see Matt talking about it. I see Rick's giving me the facts. You and Matt are talking about this. I'm like, okay. But wait, Liz, you're talking about, you're getting outbid and you know what the hell you're doing. I'm somebody who has no idea. Like, how do I even have a chance if that's the case?
I think there's two things, like, what uniqueness can you bring to the table? I think that helps. I think what up and coming markets are starting to, they're not all Raleigh, North Carolina. They're not all Austin, Texas. Those are very strong markets, no question. But we will tend to invest in, wherever the hottest markets are, we'll do like an hour and a half from those markets. That's our kind of strategy. And so these are up and coming markets. Like I said, Fayetteville 3 years ago, it's actually much stronger. We're literally doubling. We bought each unit for $35 a door, selling it at $70, right? So that's good for our investors, right? So my point in saying that is that was an up and coming market. The other piece of it is that you need to like look at what uniqueness can you bring to the table. We tend to buy more distressed assets, right? So we're going in, I mean, we got our start in Trenton, New Jersey. So when I say we got our start in distressed markets that weren't the easy, just change the countertop, put some paint and you're good to go with Class B. That was not our start. We got started kind of where we could afford, and we wanted to make a difference, to be honest. And we could afford properties there, and we wanted to make a difference. So my point in saying that is Fayetteville, that property was definitely Class C, even in terms of condition and interior, exterior, the brand. So it's a bigger turnaround. Not every company, right? So especially the more institutional probably companies want to deal with that. They want to deal with maybe an easier lift, quite honestly. But an up and coming investor, not up and coming, but an investor that's a little more, put the shirt, whatever it's called.
Got to roll up your sleeves.
Yeah, roll up your sleeves. I'm like
dirty,
horrible
right?
at that. End of the day, it's East Coast here, so I start to lose my words. And I have 2 young kids; they take all my knowledge. But my point in saying that is that you have to say what uniqueness can we bring to the table. So while some investors look at those deals and they're like, I don't want to deal with that. I want the just classic value add. We're like, give us more of those. We want more of there was 4 active drug dealers, right, at this property when we bought it, literally. No one wanted to rent. I mean, this was a brand image, whole turnaround. It's not the easiest thing to do. Now, we live in Pennsylvania. This is in North Carolina. So my point in saying that is that's a unique vantage point for the space that we're in. We also are building relationships with property managers, with any market. We're in 4 markets, and we're constantly building relationships with new people. The people that we're constantly doing that to stay in front of them. If you're new in this business, I would say, what markets do you want to get involved in? Number one, what asset class do you want to get involved in? And start helping those seasoned investors now. Everyone needs help. Everyone needs support, especially a growing company, especially now. Finding money, easy. Finding deals, harder, hands down. So I would just say, in a lot of ways, you have something to give. Everyone that wants to get into real estate investing has something to give, whether you have time, whether you have money, whether you just have like heart, whether you have hustle, whether you have like this analytical mind. Find companies that you want to be maybe help, or current investors that you want to help support. Get part of their team so you can maybe ride on their curtails, learn from them, and then maybe break out into your own. I would be doing that now. If that was me starting out right now, I wouldn't try to do it on my own, especially in this market. That's just me. But if you wanted to break out and you're on your own, you have to look at the unique piece. We're even looking at a lot more new construction. We have 2 properties right now, projects right now where we're building 50 units. And it's newer for us. We built like townhomes as a team, but we've never built like larger multis. So we're partnering and with a construction team on that. And that's just a unique, not everyone wants to do. It's another unique kind of proposition to this process we're in. So I don't know if that helps, but I would say, you have to kind of look at where all the eyeballs are going. How can I decrease all the eyeballs, and maybe like, what can I uniquely get involved in that there's a need, affordable housing, and also that it's not like literally 30 offers on the property, because there's markets that there's less,
But there is what Liz just talked about is spot on. But if you go back to the Trenton example, and I have to find out what part of Pennsylvania you're from. I'm actually a transplanted Pennsylvanian myself. So
okay, I live in New Hope right now.
Oh, we used to go to Bucks County all the time. We'll talk about it later. Anyway, go Eagles. The Trenton example is a great example of adding value to a community, which an investor can do, but it's also an example of an investor taking on risk.
Right.
And if you're starting out in the business, it's probably not a coincidence that both Liz and Matt started with duplexes, because you probably want to start with something a little easier than a complete redo where there's meth labs in the building.
Absolutely.
But the rental market, and Matt was talking about.
Wait, I can't go Breaking Bad, Rick. I can't just start a meth lab and dang it.
You can. It's no risk, no reward. But on the other hand, you may not want to put your whole nest egg into that as your first try. And the notion of working with other investors is a great idea. But you guys touched on some huge national trends, both Matt and Liz. The rental market is on fire right now. We've actually seen a decline in the number of fix and flip sales on a year-over-year and quarter-over-quarter basis. We've seen many more investors going into that single family rental or multifamily market. rental rates are up 11% year over year.
Mm.
11% nationally. There are some markets that you're looking at 20% rent increases, and many of those markets are exactly what Liz was just describing. They're the secondary and tertiary markets. When COVID hit, one of the trends we saw was people moving out of New York, out of San Francisco, out of LA, to a lesser extent out of Seattle, into surrounding markets, into the suburbs, or even slightly smaller cities that are a ways away for health reasons. But they're also doing it because they can work from home now. And if they can work from home, they don't need to be tethered to that really expensive apartment in the city. And they found out it really wasn't all that much fun being quarantined in a 700 square foot apartment with a toddler. So they're moving out, and they're moving into bigger areas. To Matt's point about cap rates, and anybody who's on the call today wanting to get into investing needs to learn what cap rates are all about, because that's how you judge whether something represents a good investment or not. And this is way oversimplified, so Matt and Liz, please forgive me, but it's not unusual that as prices go up, cap rates come down. It's just they're more expensive. So since you guys really focus in the multifamily market, it's in the commercial market, two areas for people to look at. It'd be interesting to see if you're seeing the same trends. The two commercial segments that were hit the hardest by the pandemic were the hotel sector and the retail sector. The third hardest hit was probably the office market. So there are probably a lot of small dollar buildings in those categories that are going to represent buying opportunities. And in fact, we've seen a 230% increase in hotel sales year over year. Most of them are small hotels that were owned by individual investors who didn't have the financial backing to weather a second year of lower than average occupancy rates. So think, your Marriott Fairfield Inn, your Hilton Garden Inn, those kind of limited service hotels. But I think that's where we're going to see a lot of not foreclosure sales, but distressed sales in hotels, in retail, in small office, as we kind of work our way through the end of this pandemic.
Yeah. And I was going to say, I want to bring Matt into this conversation. Before we do, I want to let everybody know, I've seen your guys' comments, Joe, Thomas, your guys' questions. We will get to those questions. You're not being ignored. I promise you're not being ignored. Matt, I know you guys have some stuff to add on this, because there's a lot of points in there that they kind of added onto. That Million Acres, for those who are just getting started, like your guys' platform, Million Acres, can actually help you, to one of Liz's points, depending on the demographic, the asset class you're in. You guys help find those investment properties, you help find investors, and that's really what a Million Acres is set up for.
Yeah, that's right. I mean, if I could describe it, we've got a ton of investors. For example, if Liz saw a deal that she wanted to raise equity for, she could come to Million Acres and we could drive our investors to her deals. And because that's what I want to do. I want to connect our investors to great sponsors and managers like Liz, who are finding deals, like she mentioned, that you're not going to find, you really can't find in the public markets, or sort of with, competing with institutions in the private world. And that's really exciting. Just following up on Rick's points, I think there are going to be some definite opportunities in hospitality. In fact, I would probably be looking at hospitality before I'd look at office, even though historically hospitality's had a lot more risk to it. I just think if there's one category of the real estate market that has really
He's coming back, ladies and gentlemen. Just give him a second. There he is.
Sorry. I mean, what I was saying is, I think if there's one part of the market that's really changed forever, potentially, it could be the office market. Whereas I feel like hospitality in the right markets is going to bounce back to where it was. Retail has already been in a sort of multi-year slide, and we kind of know the future there a little bit. But office is such a big uncertainty to me that dust to settle until we know exactly what the relationship between workers in the office is going to be like in a year from now, which I think is still very uncertain.
I was going to ask that same thing, because there's a lot of people here in my local community. We live in a lot of people have been asking, well, is it time to invest in, in commercial real estate? Is everybody moving out? The building that I'm sitting in right now, there's a lot of people, the tenants were moving out. So it actually just switched hands, and I wish I would have invested in this one. Dang it, I missed this opportunity. But a lot of people are asking that question. Is it time to invest in commercials? Is it time hospitality? That's a whole nother, a lot of people, are saying, hey, is that too much risk? Because a lot of times when it comes to hospitality, and we all know during the pandemic, the hospitality industry was hit hard, very, very hard. But if you find the right deal at the right time, which now timing is everything. We all know that in real estate. Now may be the time to start looking at those deals. So Shred Hotel, it's coming, ladies and gentlemen. You wait. But so again, Matt, finding those deals, those are fewer and far between. You just have to know, again, you have to be part of the right communities to look for those deals and be part of those deals.
Yeah, that's right. And I'm sorry about my connection today. It's been
All good,
terrible,
man.
But yeah, I think having relationships is the biggest one in real estate. Having relationships with someone like Liz or other sponsors that we work with, where we know the track record, we know they're sourcing off-market deals with brokers because they have these long-term relationships. It makes us a lot more confident that you're not competing with, you know, multiple bidders on any given commercial deal, and you're probably getting a pretty decent valuation. But it's tough out there. It's really competitive, and you know, I think there, as we talked about a little bit earlier, there's a lot of institutions in the space now that there weren't back in, say, 2009, 10, coming out of the last recession. And so it does make it a little more competitive. And, you know, we joke about the Wall Street gobbling up, you know, housing and things like that. It is happening on a bigger scale today than it was 10 years ago, for sure. So there is a lot more competition on multiple levels out there. And I think your best you know, advice as an investor is to partner with great firms who've done it before, learn what you can, invest alongside them, and then maybe eventually go out on your own later on.
Josh, if I could piggyback, because what Matt and Rick are saying are great. And I just want to mention another opportunity that's fallen onto our laps, and we're just, you know, evaluating, is conversions. So there's a motel that, you know, went into a foreclosure, and we're going through the process because that'll be our first kind of quote unquote conversion. We renovated multis, but not converted it. So again, you want to tread to what you were saying, Rick, you know, your risk level, right? We're in our 20s, you know, my husband and I, like, well, what's the worst that can happen? You know, what the hell? And now it's like that risk, you actually get a little smarter and a little more seasoned, right? You're putting people's money to work. We're all about mitigating risk, right? We're not going to increase our risk. We've, if anything, decreased our risk with obviously trying to create the right processes and teams. So, but the conversion is interesting, especially with so much commercial and so much, you know, hotels and what have you, kind of being repositioned anyway. I think that's an opportunity. Again, you know, there's a whole level of expertise that goes into that, and you got to make sure you get the right people telling you the right things. But it's almost like what takes a little more work, that's what most people aren't going to do. Let's be frank. You know, whatever's the easiest, most people do. I mean, unless you just have that unique ability to say, I want this, I want to start investing. How can I do it in today's economy, in today's market? Because it's not going to change anytime soon, or at least I don't know. Rick and Matt can speak to this more probably in terms of forecasting. I'm not a forecaster, but I can just tell you, I think there's always time. In the market, there's always an opportunity to make money. I do believe that. And so in some ways, like, where are all the eyeballs not going? And then how do you convert that to something that's needed? And affordable housing is needed. I know that hands down, depending on where you are, how much of it is needed. You'll have to do your own research. But again, the conversion part, we have something we're actually seriously considering, trying to find the right team members to make sure we get into something that is the right thing for our investors. But it's exciting. And I think that's going to be more and more the opportunities, either new construction or conversions for us, because of the hotness of the market and what's happening. So if I could just offer that, and that could be on a small level, you know, that could be, doesn't have to be a huge motel if you're a new investor. I wouldn't suggest that unless you're part of a team. Don't over risk yourself, you know, over leverage yourself, I should say.
So I have to wait for the Shred Hotel, Liz? What are you telling me here? Come
maybe
on.
Just a Shred like unit, Shred, like maybe like a little, like something, you know.
Rick, I know you want to talk about forecasting a little bit here, because this is something where you do specialize. So talk a little bit more about that.
Actually, I wanted to piggyback on what Liz said. We're going to go completely off script here, Josh, because one of the questions in the Q&A area is about conversions. It's about what are the opportunities to convert office space, for example, into residential units. And something that Matt was talking about earlier was that retail has been sort of struggling for a number of years. We're seeing a lot, actually the number of retail units sold, again, another high year-over-year increase compared to where we were a year ago, even 2 years ago. But a lot of that's because we're seeing very creative reuse of facilities, particularly true in suburban malls. That one of the properties we sold when I was at auction.com 10X was a suburban mall in South Carolina that went to a municipal government that moved all of their offices into what used to be a mall. We've seen Amazon go out and buy JCPenney stores and convert them into warehouse and distribution centers because they happen to be closer to the end customer. So I'm not at all hesitant to suggest that the retail market as we once knew it is probably not going to come back to its prior days of glory. But I think the notion of converting a motel into affordable housing units, to convert multifamily apartments into condos or vice versa, to convert retail centers, whether they're big shopping malls or local strip centers, into multiple use properties. I think you're going to see a lot of that. And that's where creativity and having a vision as an investor really comes into play. Some of the things that Liz was talking about, and also finding the right investors to back that vision, because going into a vision with no capital is a great way to have that building go back up for sale in a few months.
Yeah, Matt, I want to bring you into this part of the conversation because I think this is, you have to, both Liz and Rick kind of mentioned this, having the right relationships. You kind of mentioned that earlier, the right community, the right people surrounding you, the right investors. Is that more important? Again, especially if you're just getting started, is that probably one of the most key elements when it comes to those who are getting started in this piece?
Yeah, I mean, I think what we try to do at Million Acres is we bring a bunch of investors together. And by the way, at Million Acres, we invest in every deal we do alongside our investors. And so the idea is, like, maybe you don't want to do a hotel deal, your first deal by yourself, but maybe we can find a hotel deal out in the marketplace. We bring together 100 investors to raise the equity for it. And that way you're investing in a small slice of the equity. You're not putting your entire net worth into a deal that could go bad. You're investing a small portion of your net worth into a deal that might work out. And if it doesn't, the only thing you're losing is your equity investment. And so that's kind of our model at Million Acres. And we like the idea of community, right? Which is we're bringing a bunch of investors together. They can talk to each other. We can hang out. We do events. But we're investing in the private market in a crowd-funded, sourced way. And I think that's a way for, if you are interested in the commercial market, whether it's retail, hospitality, even the office, you can do that in a diversified way where you're not betting your own net worth on a single deal. You can do it multiple times. I mean, we have investors who invested in probably 10 plus of our deals. And so they've built their own kind of diversified portfolio of private opportunities. And they do it together, and we can talk about it, and we're all kind of, invested in the same deals, and we talk about them. So I think those are the opportunities I would do if I'm starting out thinking about doing a big private investment in a deal. I can do it in a crowdfunded way and probably, push away a lot of the risk.
And I think that's a big one. And Liz, I would love to kind of hear your thoughts on that when it comes to, especially getting in started. There is so much, it's high risk, high reward. But when it comes to raising money, building capital, where do you recommend? Again, you've been doing this for so long, you understand the game. Where do you start?
Yeah. And I would just piggyback on, I just want to speak to what Matt was saying too, is how important community is. And just people having your back, and you being able to run things by people that don't have always a motive to help you for any reason. I mean, everyone's selling something ultimately, right? But there should be a community. You should have people in your circle that's doing it versus asking your uncle or your aunt, should I invest in real estate? And they don't own property. Those are probably not the best people to ask. They could be private lenders for you, or maybe, but we often ask people for support that aren't really qualified to support us. So I just think that's so important, whatever tribe, circle you want to be part of. And that's why we're so, passionate about what we're doing over in the investor community, because we literally have meetups in almost every area of the country we're getting there. And the point is that, just women coming together and helping each other. Who do you use as a local contractor? Who do you use as a local electrician? So I just can't speak how important it is to have people's back and do it in a way that's safe, especially for the women that we serve. In terms of building
out, Liz, I want to touch on this because I want everybody to make sure that settles in. What you said is so powerful. And sometimes I think as humans, we have that human nature to go ask the people we're closest to that they're not experts. Right. We'll ask Uncle Dave because Uncle Dave's always been there. Hey, what do you think on this investment, Dave? Is the Shred Hotel the way to go? They may not be the person to ask. So what you just touched on, I don't mean to interrupt you there, but that is critical. I want all of you thinking about that, to take that and say, hey, you know what? I need to get get involved. I need to reach out to Liz. I need to reach out to Matt. I need to get part of these communities so you can start getting properly educated on this and not just asking, friends and family. Sorry, keep it going on that, Liz.
Yeah, no. And I wanted to segue, you asked about raising money and building capital. That's always something that's one strategy, I'll say. You'll have some investors that are very successful that have deployed their own capital. They built very successful portfolios and they're happy with what they have, and that's what they do. There's other people that, our first deal was my father loaned us money, right? So we didn't have 30 grand to put into a property. And so we got our start that way. Obviously raising capital is not to be done lightly, I'll say, right? I mean, in some people kind of say it so flippantly, like, oh, I'll just raise some money and buy this property. I'm like, okay, it's someone else's retirement money, first off, or their life savings. These are the people we have about 250 investors we work with over the years. And these are, this is like the millionaire next door, right? These are folks that have redeployed their IRAs, have built a successful, maybe, profession. These aren't just like Donald Trump's, that's a horrible example of people, but sorry, however you feel about him, it's a horrible example to use. But anyway, it's not just the people that may have just so much money, they just don't know what to do with it, or they forget they're investing with us. These are just everyday people trying to deploy their money and have a return on their money. So we don't take that lightly. I think the biggest thing that people that want to get into larger assets, because that's the biggest question, right? I want to buy 100 units. Everyone, you hear that so much on these podcasts. You need to start small. I'm a big fan of that. I don't know if everyone would agree with that, but I am someone that I think us starting small and us kind of having some learned lessons and deploying our own kind of close family and friends, we kind of I hate to say it, but you earn the right. And people don't talk about that, not earning the right, like you shouldn't dream big, but you have to have some, you have to kind of get beat up a little bit. You got to make some mistakes and you got to do it on your own dime. I don't want to lose someone else's money. I don't want to lose my own money. But I mean, over the years, that would be you talk about responsibility, right? I mean, that's a big responsibility. And what comes along with that is really protecting people's money. And then obviously making them the returns, but protecting their capital. So we started very slowly. We did friends and family. We kind of scrapped together some money. We bought a property and using our credit card, which I don't suggest to anyone. Some of the things we did early on, but we just wanted to get involved. We were just we're going to do this no matter what. Obviously we don't do that anymore. But regardless, I'm just saying that from the perspective of being able to have a track record, being able to have some successes and saying, this is my business, this is what I'm going all in on. And then in terms of raising money, you could start to do that in a small way. We didn't start with 200 investors, right? It started with one, and then it grew. And then we started to have some success. And then we said, okay, we're going to go all in on multifamily. And how we're going to do it is we're going to syndicate, which basically means you're going to pull money together. It's a very fancy way. People like to say syndicate, but in a sense, it's you're pooling money together from a lot of individuals and they become limited partners in your company in a sense. And you're the general partner along with maybe others that are part of the kind of business, running the business plan and running the property. So we started very small. And I will say too, we did it with 2 single family homes. Our first private money deal was not a 200 unit. It was 2 single family homes in Trenton. And I met I'll just give a quick story. I met this gentleman in college. We were kind of networking together. And I said to him, hey, we're growing our portfolio. We had about 30 units at the time. We were kind of tapped out in terms of our own resources, our own close, parents and people that had the same last name as us. And we just really were looking to grow. We started to have some success, but we ran out of money. And I was talking with this gentleman, a friend, and he said, I would love to get involved in real estate. I just don't have the time. I said, that's awesome, because me and my husband have a lot of time. This is what we do full time. This is our full-time focus. And that started a great partnership. So we started an LLC. He didn't lend us money. There's private lending and there's equity. We went down the equity side. We have more experience on the equity side. But anyway, him and I, our teams came together 50-50, started an LLC, 123 Main Street, bought those 2 single family homes. They're both 2-1s. And, we were able to refinance the property, the classic, buying under value, renovating it, the Burr strategy as people will talk about. And we took his money out, $50,000, and then did it over and over again. He's still an equity partner of ours 12 years later. So, you don't have to start with something that's enormous. You could start with one property. We put $0 in, he put 50,000 in, we put our track record and our local connections. So raising money could be very like, oh, I can't do that, but you can do it in a way that works. And I'd also say just starting out and having a track record, having experience, having something to bring to the table is critical, in my opinion, if you're going to actually work with other people's money, in my 2 cents.
Well, and I think that's absolutely brilliant. You have to start small. So Rick, we're going to take our money. We'll wait for the Shred Hotel. We'll find a smaller investment. You and I will figure it out. But I want to kind of, as we start to wrap things up, we want to be respectful of everybody's time. Because again, we appreciate everybody being here. We appreciate all the panelists and them sharing their expertise and their knowledge in this. And there have been some awesome questions. I want to get to a few of these questions and a few of these great comments. Joe Enos Farias, you had some great comments here. Actually commented on this. A lot of these webinars are great, but they fail in regards to addressing the needs of new investors, feeling lost, abandoned, confused, and then give up because of the support. But he wants to applaud us all because that's exactly, we're trying to help. We're trying, and this is just the beginning. I have a feeling this is one of many webinars to come for all of you. I feel this team here, we have a lot to add. And again, we're just starting to hit the tip of the iceberg here. So I want to, as we start wrapping this up, as we start to kind of break this all down, what are some of the best ways, I mentioned this to you again a second ago, Matt, getting involved with community, surrounding yourself with the right team, that has to probably be one of the most important things, getting involved with a company like Liz and really starting those conversations. Like you said, start small, start from somebody who has been there, who's done that. They've made the mistakes. You can now piggyback off the mistakes they've made and you can learn from them. Probably one of the most valuable things, not just the money and the investors, but the knowledge that you can pull from getting in part of some of these communities and some of these conversations. So none of us are armies of one. So this question that came in, none of us are armies of one. How do you guys make the magic happen? Where do you start to build the team, start to put these teams together, if you will?
Well, and you don't have to start with by the way, doing your own deal as Liz and I have done with our own properties and renovating them and doing it that way. I mean, you can invest $100 in a real estate investment trust in the stock market and get some exposure to real estate right there. You can do some of the crowdfunding deals that I've mentioned. Syndicated deals. That's what Liz is talking about. I think what you should do is if you get together with people who are interested in doing the same thing you're doing. It feels like we read things, we listen to podcasts, we read Rich Dad, Poor Dad. But we don't have mentors. We don't have people that we bounce ideas off. Uncle Dave is not the guy you want to talk to usually. It's really about people who have the shared interest. I'm lucky that over the last 15 years or so, I've had some buddies of mine who have also invested in real estate, who I've worked with, invested with together. And, we invest in each other's deals. And that's been a huge benefit. And by the way, I'm nowhere without my wife that I met, 15 years ago and married 12 years ago. So, I mean, it's just because she had the same interests that I had, same passions that I did. And that's meant such a difference in everything we've done. So I would start right there, right? Who are my family and friends? And are there family and friends who have the same interests and are willing to learn and take the steps like I've done? And then, you take that to the next level. As soon as you start doing deals, like Liz talked about, you meet general contractors. You meet people who are investing you meet brokers, you meet people who are investing in your community, in your towns. And you start to get a sense of what deals are out there. You work with lenders. And you build this network out, but it takes time. It's brick by brick, step by step, and eventually 10 years down the road, you've got this huge Rolodex of 100 people that you can rely on and talk to and bounce ideas off of, and that's pretty priceless.
Yeah, I would agree with that. I think building the community, we talk about in mortgage and real estate and investing, it's about relationships, it's about community, it's about surrounding yourself with the right people. And that comes little by little by little. A couple of questions that have come in, we've had this 3 or 4 times. How can I find a recording of this discussion? If you sign up for the webinar, you will actually get a recording. We'll send you a link so you can rewatch the recording of it. You can go back and we actually will be putting together some snippets of this incredible conversation as well. So that just to make sure everybody is aware of that. I want to get one last question, maybe 1 or 2 more if we can here, from Joe. Can you share when the peak of the distressed tidal wave will take place? Good, Joe, if we had tidal balls, dude, we'd all be billionaires. Trust me. We all wish we'd know exactly when it was going to happen. Is it going to happen in 2022? Is it going to happen in 2021? We don't know. Is it going to happen at all? Rick, your thoughts on that? What's your thoughts?
We're not going to have a tidal wave, Joe. Sorry to disappoint you. We're going to have a few waves. In fact, We'll be announcing August foreclosure numbers in a couple days. And you're getting a sneak preview here, but nationally they went up about 21%. Now that's off a very, very, very small number. So it's not a huge increase, but we're going to have a wave this fall because some of the foreclosure moratorium has been lifted. We will have another small wave in the first quarter of next year when the Consumer Finance Protection Bureau's new rules for loan servicers have expired. And we'll probably have another one next summer when most everybody's gone out of the forbearance program and the servicers have exhausted all of their loan modification options with borrowers who found themselves in financial distress. But we're not going to have a tidal wave. We're going to have a few smallish waves, and we'll get probably back to a little higher than normal levels of foreclosure activity.
Well, and I want to go back to a point that Liz made so brilliantly. She said there's always opportunity in every market. Yes. Like, we're not going to see a tidal wave. We're going to see these, but now is the time. What we're sharing here, what Matt has shared, what Liz has shared, what Rick has shared, is now is the time to start preparing yourself. Now is the time to start having the conversations, getting together the right teams, being part of these communities with Million Acres and with the Real Estate Investor. Start to have those conversations, start to get yourself more knowledgeable, get educated on the process. So when you do see these smaller waves that Rick is talking about, you're prepped, you're ready, you're prepared, and you're like, hey, you know what? I've done my homework. I've done my research. I'm part of these groups. I'm part of these discussions. Now I feel confident and comfortable to jump in with both feet. So I think that's completely leads everything into this conversation. As we start to wrap things up here, any final thoughts, Liz or Matt or Rick, when it comes to anything we should be doing to prepare now? And like to Rick's point, for these waves, what should we be doing to be ready for them?
I just to mention something I get a lot in the community that I lead, and women will often ask me, this is in our membership, this is anywhere I go, should I start investing in multifamily? Should I get into short-term rentals? I hear a lot about self-storage. That seems like an interesting niche. And it's just not the first question you should actually ask. It's like the third or the fourth or the fifth question. And the first question I always recommend, and we do a lot of kind of training on, is like, what are your money goals? What are your financial goals? And I think sometimes in investing, we get very enamored with like, the sexy part of it, if you will, the renovation, watching these shows, and we think that that's the reality of what happens. And it's just not on HGTV or wherever you get intrigued with this. And you have some money to invest and what have you. So I just think getting really clear on like what your money goals are, what your financial goals are, because you might be able to get to your financial goals by being a passive investor, by being an active investor, but maybe taking less risk, taking more risk. I have no idea. So for anyone to even give you counsel on the answer of which niche or what asset class to get involved in, I feel like it's so not the first question. It should be like literally the down the road. So you have to kind of do the work, if you will. Like, look at your financial situation. What assets do you have to bring to the table? What do you bring to the table? Do you have money? Do you have time? Do you have neither? But you still want to, start creating wealth for your family. Do you want to replace your income today? Do you hate your job? Or do you like, what? I just want to build money. I want to really build wealth long-term and for retirement. And that's in 20 years, 10 years, 2 years. I have no idea. So I just think that's the kind of work that we recommend the women to do in our community often is you got to like kind of get clear on where you're headed and where you're going now, 5 years, 10 years. And then we can have those conversations of what strategically makes sense for you. It's like a financial planner saying, hey, you should get into, I'm not a financial planner, but it's like someone giving you that idea of like, hey, get involved in this stock or that stock versus like, what are your financial goals, right? What's your risk tolerance? Same things in real estate that we just don't talk about enough, in my opinion. It's often we get so focused on asset class and important, not the first thing that you should really even be talking about. So I just want to recommend that to the folks here.
I think that's like, and you nailed the perfect disclaimer. We are not financial planners, nor should this be any financial advice. Make sure that we have that in there. There you go. So, but that is absolutely brilliant. Matt, as we start to wrap things up here, any final thoughts or kind of a piggybacking on what Liz or Rick are saying here?
Yeah, couldn't have said it better than Liz. Know yourself, right? Know your goals, know what you want to do, how you want to spend your time, what you want to expose your family to, what's important to your life. And if you decide that real estate is something you want to jump into, do not do it alone. Make sure your family's in line with you and make sure that you have mentors or peers that you can bounce ideas off and work together with. And I think exactly, you get those things right first, then you can start talking about where you want to invest, what you want to invest in, how you want to do it, but get those, get those personal questions answered first.
Well, and I think that's just brilliant. And that's having both of you on here. That's why we're so excited to have all of you. But I mean, Liz and Matt with Million Acres and Liz with Real Estate Invest Her, get involved with the communities. Start asking the questions, get yourself educated, start being, like I said, start asking the right questions. Liz made a brilliant point. So many of us, if you're just getting started, you don't even know what questions to ask yet. So make sure that you have your priorities set straight before you're just like, hey, I got all my chips. I'm all in. Let's make this bet. We're going big. So make sure you're educated on that. So with that, guys, we do want to start wrapping things up. We want to have a huge shout out to Liz, Rick, and Matt for joining us and being willing to take time out of their busy days being willing to share everything that they have. And like we said, we just were able to scratch the tip of the surface on this one. Like to Joe's point, or to Thomas's question, or to comments as well, is we will continue to do our best to bring you some more of these, to bring you the facts, to bring you the data. As Rick knows I love data. He knows I love it, but we absolutely want to continue to educate you. We want you guys to be involved with the waves that Rick mentioned. Now is the time to start getting educated so you can make the best decisions for you and yours. I love what Matt said. Make sure you involve your family, have those discussions, bring your loved ones along for the ride, because who better to support you in the future? So with that, ladies and gentlemen, we want to thank everyone for being a part of this. Thank you so much for the questions. Thank you so much for joining us. And like I said, make sure you click the links in the chat to make sure you follow Matt, Rick, and Liz on all of their social feeds. From everybody here at Shred, from everybody here involved with the webinar, again, we want to thank you for taking time out of your busy day and joining us. And we look forward to continuing to educate you guys with another webinar in the future. With that, guys, we appreciate you. We love you. Now it's time for all of you to go shred, go show up, hustle, repeat every day. We'll see you guys soon. Hey, what's up, everybody? Thank you again so much for joining us for today's show. If you like the content, make sure you hit that like button below. And if you already haven't subscribed to our channel, click right over here and you can subscribe to our YouTube channel. And if you want to see our latest video, click over here. And again, if you want to see the best of daily content within the mortgage and real estate industries, you have to subscribe now. We look forward to having you shred with us every single day.